All right, welcome to Talk Tickers. Today, we're diving deep into JPMorgan's fourth quarter 2025 earnings call. And let me tell you, it was a weird one. The bank actually put up some really strong numbers underneath the surface. But the market, yeah, it absolutely hammered the stock. So, what on earth happened? Let's get into it.
And this right here, this is the big question, isn't it? JP Morgan beat on adjusted earnings, the number that Wall Street supposedly cares about the most. So why did the stock just tank? I mean, we're talking about one of its worst post-earnings drops in a long time. It makes no sense on the surface, which is exactly why we're going to peel back the layers and figure this thing out.
I mean, just look at this. It really puts the whole puzzle into perspective. On one hand, you've got a solid beat on their adjusted earnings per share. Thumbs up, right? But then, bam, the stock gets crushed, down over 4%. And look, that's not just a little profit taking. No, that's the market screaming that it did not like something it heard. But what was it?
Okay, so to get to the bottom of this, we've got to start where everyone else did, the headline numbers. And you know, this is where things start to get messy. Because it turns out, this wasn't just one earnings report. It was kind of like a tale of two completely different reports, all rolled into one.
So check this out. It's a real split decision. You've got GAAP EPS. That's the official, by-the-book, no funny business number, and that was a miss. But then you have the adjusted EPS, which is where they pull out some of the weird one-time stuff, and that was a really solid beat. Throw in a tiny miss on revenue, and you can just imagine the chaos in the news headlines. Total confusion. Let's just focus on that GAAP number for a second. They missed by 22 cents a share. Now, for a fortress like JP Morgan, a company known for its consistency, any kind of miss gets people's attention. And you can bet this is the number that all the instant news alerts blasted out right away.
But flip the coin, and you see this. The adjusted number beats by 23 cents, and this is the number that's supposed to show how the actual core business is doing. So you've got a beat and a miss for the same quarter. How is that even possible? It's the classic Wall Street conundrum.
So, in the end, which story did the market believe? Well, the verdict was fast and it was brutal, a drop of almost $14 a share. What that tells you, loud and clear, is that investors didn't care about that adjusted beat. They looked right past it and saw something else that spooked them. The headline numbers, they weren't the real story here, not even close.
So if it wasn't the headlines, what was the real story? Well, it all comes down to the one thing that made those headlines so messy in the first place. It was a single, huge strategic move. JP Morgan buying the Apple Card portfolio from Goldman Sachs. Okay, this is the absolute key to understanding the headline miss. When a bank buys a bunch of loans, in this case, all the Apple Card accounts, they have to set aside a pile of cash right away just in case some of those loans go bad in the future. It's called a net reserve build, and in this case, it was a massive $2.1 billion. That one accounting move, which is totally normal by the way, is the only reason the adjusted beat got flipped into a GAAP miss.
Now, of course, management was selling this as a huge win for the long run. And, you know, they're not wrong. They get a huge, high-profile portfolio, they beef up their already massive credit card business, and they lock in a partnership with Apple. What's the catch? Well, they were pretty honest about it on the call. Integrating Apple's super unique, built-from-the-ground-up tech is going to be a beast of a project, taking at least 2 years. So, yeah, it's a big bet, with a really big price tag up front.
Okay, so let's pause. If the market is smart, and usually it is, it should understand that the Apple Card charge was a one-time thing, so that can't be what really caused such a massive sell-off, right? Right. The real answer, the thing that truly scared investors, wasn't in the past quarter's results. It was in the company's forecast for the future.
And this, right here, this is the chart that probably sent coffee flying across trading desks. Look, their guidance for net interest income, that's the core profit from lending, was pretty good, around $95 billion. But then, look at the expense guidance, $105 billion. That means their costs are expected to be way higher than their core earnings. That's a huge red flag for profit margins, because it means they're planning to spend an absolute ton of money on tech, new branches, and marketing.
And if that wasn't enough to make investors nervous, the tone from CEO Jamie Dimon was, well, it was pretty gloomy. He basically said, we have to deal with the world we got, not the world we want. He kept talking about all these huge risks out there, both globally and in the economy. Now you tell me, does that sound like a guy who's super confident about a massive new spending plan? Not really.
So let's put it all together. Now it makes sense. The stock didn't sell off because of the Apple Card accounting thing. That was just noise. It sold off because of a perfect storm of future worries. You had a miss in investment banking, which is a key business. You had that jaw-dropping expense number for next year. And then there was a brand new threat, one aimed right at the heart of their most profitable business.
And this was the real bombshell dropped during the Q&A. Someone asked about a proposal floating around Washington to cap credit card interest rates, and management's response was chilling. They said it would be severely negative. They basically said they'd have to cut off credit for millions of regular people. You got to understand, for JPMorgan, credit cards are a cash cow. This kind of regulation is a massive, massive new risk.
So there you have it. You've got the mixed results, the big long-term bet on Apple Card, and some really serious short-term risks piling up. So the big question is, where do we go from here? What should we be looking for in the next quarter?
All right, here's our official take for the next call. We think their net interest income is going to feel some pressure as the Fed starts cutting rates. The good news is the consumer is still hanging in there, so that should provide some support. But is it enough to send the stock soaring? Probably not. We see the stock kind of stuck in a trading range, probably between $300 and $320, while the market just waits and watches to see if this big spend money to make money plan actually works. Because of all that uncertainty, our final rating is market perform.
And really, that's the whole story in a nutshell. JPMorgan is playing the long game. They're spending billions now, taking a hit on margins, all to try and cement their #1 spot for the next decade. So the question you have to ask yourself as an investor is this: do you have the stomach to ride out the short-term pain and some pretty scary political risks for a potential payoff way down the road? That's the bet you're making.
And of course, a reminder, this is not financial advice.